In this video, you'll learn what a cash flow statement is, why it matters, and how to make one, step by step. Many people feel stuck at this point. They see cash numbers on reports, but they don't know where the money came from or where it went. That's why the cash flow statement is so useful. I'll show you what it means, how it works, and how to build it using easy examples. By the end, you'll understand how money moves in and out of a business, how to put that into a simple report, and how to see the real cash position, not just profit on paper. Let's get started. Let's talk about what a cash flow statement really is. It's a report that shows how money moves in and out of a business during a specific period, like a month or a year. It doesn't show profit. It shows real cash, the actual money going in and the money going out. That's important, because sometimes a business looks profitable on paper but still runs out of cash. This report helps you see what's really happening with the money. The cash flow statement is divided into three parts: cash from operating activities, cash from investing activities, and cash from financing activities. Each section tells a different part of the story. And remember, it only tracks cash, not invoices, not credit, just real money that is moved. Now let's see why this is so important. Now let's talk about why the cash flow statement really matters. Just because a business makes a profit doesn't mean it has cash in the bank. A business can look good on paper but still run out of money, and that's a big problem. Cash is what pays the bills. Cash is what keeps the business running. This report shows if the business has enough money to pay suppliers, cover salaries, reinvest in equipment, or make it through a slow sales month. It helps you understand if the business is healthy, not just profitable. That's why the cash flow statement is so important for owners, for investors, and for lenders. It shows if the business can stay alive. Now let's break down the structure of the cash flow statement. It has three main sections. First, cash flow from operating activities. This is the core of your business. It includes cash from sales, payments to suppliers, wages, rent, and other daily costs. This is the most important part because it shows how much cash your main business activities are bringing in. Second, cash flow from investing activities. This includes cash spent on buying or selling assets, like equipment, property, or long-term tools. If you buy a new computer or vehicle for the business, it goes here. Third, cash flow from financing activities. This is where you record money from loans, owner investments, or any money taken out of the business, like drawings or repayments. Each of these three sections ends with a subtotal. It tells you how much cash came in or went out from that area. Let's walk through a full example using the same numbers we've used in previous videos. Here are the transactions. The business earned $800 from sales. It paid $200 in rent and $100 for advertising. The owner invested $2,000 into the business. The business bought equipment for $1,000, and the owner took $300 as a personal drawing. Let's break it down by section. Operating activities. Start with the cash sales. That's $800. Then subtract rent, $200, and subtract advertising, $100. That leaves us with $500 in positive cash flow from operations. Investing activities. We purchased equipment for $1,000. That's a cash outflow, so this section totals $1,000. Financing activities. The owner invested $2,000, then took out $300, so we're left with $1,700 in positive cash flow from financing. Now let's calculate the total net cash flow. $500 from operations, $1,000 from investing, $1,700 from financing. The result? $1,200 net cash flow. And that gives us the final line. Cash at the end of the period, $1,200. That's your full cash flow statement, step by step. Now, let's look at some common mistakes to avoid. Let's go over some common mistakes many people make when preparing a cash flow statement, and how you can avoid them. The first mistake is confusing cash flow with income. Just because a business shows a profit on the income statement doesn't mean it has cash in hand. The cash flow statement only tracks real cash, not unpaid invoices or credit sales. Another common issue is forgetting about non-cash items, like depreciation. These are included in the income statement, but they don't affect your cash flow, so never include them in the cash flow statement. Next, don't mix up the three sections. Many people accidentally place financing activities under operating, or mix investing with expenses. Remember, daily business operations go under operating, equipment and assets under investing, and owner-related money under financing. And finally, if you're tracking cash flow over time, don't skip the beginning cash balance. Without it, your ending balance may look wrong, even if the math is right. Always start with how much cash you had at the beginning of the period, and then add or subtract the changes. Avoiding these mistakes keeps your cash flow statement accurate, easy to read, and useful for real decisions. Next, let's see how the cash flow statement connects to everything else you've learned so far. The cash flow statement doesn't stand alone. It connects directly to the other two main financial reports. It starts where the income statement ends, with net income. But instead of just reporting profit, it adjusts that number for real cash activity. It removes things that didn't involve actual money, like depreciation. And it includes real cash events, like loan payments, equipment purchases, or owner withdrawals. Then, it ends with the final cash balance. That number is the same cash amount you'll find on the balance sheet, under current assets. So in simple terms, the income statement shows performance, how much the business earned. The balance sheet shows position, what the business owns and owes at a moment in time. And the cash flow statement shows movement, how money actually moved in and out. All three statements work together. They tell one full story, from profit to financial position to the actual flow of cash. And that's why understanding this connection is so powerful. Let's quickly recap what we covered in this video. The cash flow statement shows real cash movement, not just profit. It's divided into three clear sections: operating activities for daily business, investing activities for assets, and financing activities for loans and owner money. Together, they give you a full picture of how cash enters and leaves your business. This report helps you plan, stay in control, and keep your business running, even when profits and cash don't line up. If this video helped you understand how cash flow really works, go ahead and like the video, subscribe for more clear and simple accounting lessons, and drop a comment if you're ready for the next topic, adjusting entries, or a full walkthrough of year-end financial reports. You're doing great. Let's keep going.